Welcome to Marketing with Confidence. I'm your host, Marianne Amies. We're going to be talking all things digital and online marketing for business owners and marketing professionals. If you've been feeling overwhelmed by your digital marketing, be sure to listen along and you'll hear tips, interviews and more that will give you the confidence to create marketing you love. I'm really excited today to be joined by Jason Andrew, Director and Head of Growth at SBO Financial on the CEO Briefing podcast. So hi, Jason.
Hey, Marianne. Pleasure to be here.
Oh, thank you. Look, to kick off, tell us a bit about yourself and how you came to carve out your space as a business advisor.
So I'm a chartered accountant by training.
Amazing.
And I guess, and I guess our company does accounting. But yeah, I started my career as an accountant working in accounting firms at some of the larger ones in Australia.
Yeah.
And then in 2015, I decided to make the leap and start my own kind of practice.
Awesome.
Originally, it was just focused on bookkeeping, but that has evolved since into more CFO advisory and more recently taxes as well.
Oh, fantastic. I started in accounting. I started as an accounting cadet. Yep.
Wow.
It's one of my subtle flexes. So I started as an accounting cadet and I did 18 months. I was in a second tier firm and realized that I did love the accounting work, but I really loved the newsletter and the social club and all these other really sort of marketing-esque activities that they let me do. And so in my second year of like B-Biz at UTS, and I had to choose my majors and I thought, I don't want to choose accounting. So I deflected to marketing management, but I saw, many of my friends went on to go through CPA and it's such a grueling, a qualification, you just you get your uni quals and you think you're there, but, I take my hat off to people that complete CPA because it's full on.
Yeah, it is. Most people, when they do finish their CA or CPA, they then look for another job. Basically, just hang around. Once they're done, I'm done with public practice, my firm life, and when they work at a bigger company. And it's usually something that they're personally interested in as well, like a brand that they may align with, as opposed to, one of the corporate kind of mid-tier accounting firms.
Oh, awesome. So look, one of the things I've been talking about on this podcast with different CEOs is, I guess, that big question of balance. So any insider tips from you, how you balance working on your business and working in your business?
Yeah, so we've been at our business for just like an eighth year now. So it's feels a lot longer than that. But yeah, 8th year. And I guess when we started our company, I started our business, my business partner and I, we both had this. We both kind of wanted to build a business that we could not necessarily sell, but be able to build it so that if we did get offered to buy it, we could sell it and we wouldn't be part of the furniture, if that makes sense. So
absolutely.
So we worked really hard to try to remove ourselves from the operations and even as a CEO within the business. So Vanessa is a wonderful been with us for a long time. She's our current CEO. And so we recently got her in the business to kind of operate day to day. My role is still active within certain areas around the growth and the strategy and things. But day to day, functionally, most of my time is spent on growing things and doing lovely, growing fun podcasts like this. Which is
fantastic.
I enjoy.
No, that's awesome. I mean, look, it certainly when you're growing a business, it is the biggest challenge and obviously getting to where you are and being able to make it your sole focus to work on the business, number one, so personally rewarding, it's the strategy and the planning and all that, but also the opportunities you can bring to the business by having that time focused on it is huge.
It's also very challenging to do. I think it's particularly in services businesses, just like yourself. I mean, resonate with this. I think when you're within the services business, for most services business that start from scratch, you're the business, right? Like everything is on you. Yeah. You do all the pay. You do the work for your clients, and then you have to employ people and do all the marketing for your own business. And it's easy for you to just focus on doing client work because that's the stuff that pays the bills. Knowing when you can afford to hire someone to help you and support you. It's a really tricky, hard thing to do. And I think, it's not easy. And I guess you don't need to do that either. Like, I think a lot of people are very comfortable just saying, oh, like, I love doing client focused work and I love to do that. I'm happy to do that for forever. And that's totally cool as well. So I think it really depends on what type of business you want to build and just be clear about that from the beginning.
Yeah, totally. I think I've sort of spoken about that before. You know, you can kind of hold as a solo business owner, or you can grow, or you can, productize a service business if it's possible. And I think that the challenge, and certainly for someone like myself, is letting go of task-orientated behavior. When you grow your business doing the work, the client work, it's really hard to step away from that and do strategic work that doesn't have immediate value and that someone's not waiting on you to deliver. Like, I always think, if I could be my own client, I could achieve great things for myself. But you often put off the business development piece for client work and that satisfaction of that work as well.
It's so true. I think that Seth Godin, who is a kind of a marketing
love him.
kind of god that I idolize, I think is a guy that is just kind of the tried and true principles of foundational marketing, right? But he talks about hard work versus long work, and I think everyone you speak to is like, oh, how's your day been? Like, oh, I'm so busy. Everyone's busy, right? And how Seth defines it is long work is the work like doing paid work to clients. You kind of hours in, hours out. You have a charge out rate per hour. You collect the revenue, you do billable hours, etc. Versus hard work is the type of work that there is no immediate payoff. You're kind of like doing free work. You're doing strategic stuff. You might be building, you're doing a podcast just like this. You might be doing some marketing for your own business, which again, you're not getting paid for. You can't even issue an invoice for this podcast, but over time you start to build an asset, and then that's what you're left with, which hopefully over time will actually generate and start to yield some financial return over a period. So that's how he defines it. I always think about that because it's a really great way to articulate the types of work that a CEO does. I like that. I like that idea. I love Seth Godin, but I funnily enough haven't heard that before. So it's a really good way to put it. Thank you for sharing it. What about morning habits? Do you have morning habits that set your day up for success? Well, you picked us. This is the second week of the new year, so my habits, everyone's habits are pretty good this time of year, I think, as they set their resolutions. But I try to. I'm always been an early riser, so I'm usually up at 4:30 in the morning. I do it, most days of the week at the gym up until kind of 6, and then have breakfast with the family. Got a young family, and then daycare drop off, and then at my office at my desk at 7:38. So we work from home, which is great. So I don't have to travel anywhere or commute. That's typically the routine for work days in my Friday.
Fantastic. I hear wonderful things about getting up early. I just can't get on board.
I think there's the two people who like night owls and like early risers. I'm definitely not a night owl. I'm like I'm in bed by like 8:30 most nights. Like I'm just I have a reputation amongst friends. Like I don't ever get up particularly late, like, maybe 7 o'clock. And so I get this reputation of, you must be a night owl. And I say, no. I like to go to bed early, and I like to, I like to take it from both. I just like sleep. I think, when you juggle so much, I actually think I just need the sleep. I really value the sleep and need the sleep to face what I face in a day. But no, I'm not a night owl either. I'm a sleeper. So look, I'm going to get into some of the nitty-gritty questions with you now. You've got such a wealth of knowledge that is so valuable, and I know things that people shy away from because it's not their day-to-day, it's not what they're experts in. So I want to hit you with the first question around, we all know the kind of standard reports that we need to keep an eye on, but what do you think the area is that most CEOs overlook when they're assessing financial performance? Yeah, it's a good question. I think when you think about what most CEOs do currently look at, or even just open that up to small business owners particularly. You know, and I have this every morning. What they do, you open up your net bank and you look at how much cash you have, right? Like that's
how does that balance feel today?
Yeah, the highs and lows. Like cool. If it looks a bit healthy, it's like yeah, cool. I'm in a good position, right? You feel good. So, that's how I will say. I would 90% of small business owners run their accounting or their finances is looking at how much cash I have in the bank, right? And yeah, that's fine. I mean, there's nothing wrong with looking at how much cash you got. That's important. But I think the risk with that is, or the issue that I have with that is that having cash in your bank is necessarily not an indicator of whether you have a good or a healthy business or a performing business, right? It just simply states how much you have. And because the reason is that money in your bank account could be your taxes. You might have a BAS that's owing around the corner. That could be your GST. It could be wages that need to be paid next or tomorrow or next week. So not often a good indicator of your financial performance. So when we talk about businesses and business owners and CEOs about what they should be looking at in their financials, I think there's like kind of three basics they should be looking at. First one's obviously revenue. Like, you know, what are my sales compared to my break-even point? Like, you know, how many sales do I need every month to make sure I'm at least not losing money or not making money, but like to be in business. The next one is their gross profit. So gross profit is your calculated your revenue less all of your direct costs. When I mean direct costs, any expenses that are attributed to selling your product, that's a direct cost. So if you're an e-commerce business and you're selling widgets, you know, the cost of the widget, the postage, the merchant fee attached to that widget, all of those things are cost of sales. So that's a second really important metric. And then the third one is obviously your net profit. So that's just everything at the bottom. So it's your gross profit less all the other expenses in your business, like your wages and rent and things. So that's kind of table stakes. Like essentially those things is your profit loss. So that's just your profit loss report. And then the other part of it is what most people don't look at is probably your cash flow. So in most accounting systems like Xero or QuickBooks or MYOB, you can actually generate cash flow reports out of those systems. And I find that a lot of small business owners don't look at those reports. They just the difference there is that you could be profitable on paper, but you may not have any cash because it could be all tied up in your accounts receivable, like people owe you money, or it could be tied up in your inventory and sitting in your warehouse. So that's another deception with accounting is people often just look at their cash at bank because they think, well, my P&L my profit never actually matches my bank account. And the reason for that is because a lot of it's tied up in the balance sheet. And so looking at your cash flow is again, a very good indicator to look at where how your business is performing. Yeah.
I mean, coming from my very brief time in accounting, I actually love my numbers, and I think I'm a bit different, you know, to other marketing agency owners in that respect. But I do check my bank balance often, maybe in the mornings, maybe exactly the I also love to reconcile my Xero every day. I probably shouldn't even still do my Xero, but I just take such great pleasure in doing my Xero. I love it. And I do look at my profit and loss, you know, here and there. I have never pulled up the cash flow statement ever, you know, and I imagine so many others. I'm very good at, you know, I have a good handle on what expenses we have coming up, and I read Profit First years ago, so I have my buckets, and you know, which I loved that system. It really spoke to me. But like cash flow in terms of, you know, when next quarter rolls around and we have those obligations, will we have a week of being below cash? Or, you know, I've never looked at that. And I think it's, as business owners, we go to those go-tos, those tick the box, but it's things like understanding that cash flow. And obviously, if you're going to be growing your business and making big financial decisions, to your point, it might not be today that it's a problem. You know, your revenue or your net profit might look like you can cover it, but obviously, what about next month, the next month, the next month? So I think that's such a good point, the importance of understanding the cash flow. I mean, more so, obviously, I think, and correct me if I'm wrong, in a product business and a service business in some ways. But obviously for everybody, you know, having that projection and being able to see, you know, that there's a hole in X many months is critical to forward planning.
Oh, absolutely. I think, yeah, your point about product versus service business is actually a really good one. So I think in service businesses, particularly if you've got recurring services, you're in retainers, you kind of instinctively know, what your revenue is probably going to look like. You kind of, know your wages because
it's all a bit flat.
It's all flat. It's very like steady, and so you kind of know that. And most people wouldn't hire new staff in advance of new revenue, right? So you kind of know what your profit should be every month. Where in products, like if you're in e-commerce, like every day is like you make money or lose money, right? Every day.
Yeah,
it's like,
correct.
And so a lot more pressure. And I think particularly in product-based businesses, you really need to nail your margins every single day and know your break-even point. As I alluded to before.
Oh, awesome. I am sure we've already done this as we've spoken, but obviously jargon and your industry, my industry is the same. Jargon is huge. And we talk in our acronyms, all the time, and we forget that other people don't know them. So when you and I were chatting about you coming on this podcast, you threw some acronyms at me. I'd love you to explain them to people. So you threw CAC, CLV, AOV. So what does it all mean, and why do CEOs need to get across it?
Yeah, these are so a lot of people ask. Well, it's actually a marketing question as well. So a good question, a question that we get asked a lot as finance/accountants people. I'm sure you get asked a lot as marketing people. It's like, first question is like, how much can I spend on marketing? Right? It's like, how much should I budget for this thing? Right? And most people are like, I don't know, like who knows? Like if it's hard to say, right? And like I think most people will just kind of say, oh well, they'll ask their mates. It's like, hey, you're a business like me. How much do you guys spend on ads, or how much you spend on XYZ? And so the real way to help set a budget of how much you can spend on, we'll call it paid acquisition, which is advertising, is really first understanding what is a customer worth to you. That's the first question. So I think we do that to calculate the value of a customer. You do that through a calculation called customer lifetime value. Yeah. And that's the first one, CLV or LTV, lifetime value or CLV. Again, acronyms are interchangeable.
Yes, of course.
LTV or CLV, they're the same thing, customer lifetime value. And what you're trying to do there is put a financial value on your customer, right? Mm-hmm. So how much is a customer worth to you over their journey with your business? And so there are, again, looking at different acronyms, there's actually multiple ways on the internet of how to calculate this. Yeah. But this is the tried and true way to do it is you look at your gross profit that this customer brings to you. So it's the gross profit per month multiplied by the time length that they're expected to be with you as a customer. So for example, if we'll talk about my business, SBO, an accounting firm, say if a customer pays me $10,000 a year in gross profit. So let's just say that their revenue, they actually pay us in $20,000 a annum of revenue. I pay my staff $10,000 of costs to service that account. So I've got $10,000 left of gross profit. If my average customer tenure with my company is called 3 years, I will say then, okay, well, it's $10,000 a year times 3. So a customer is worth $30,000 to me over their lifetime value, right? Yeah. So that's kind of that's what CLV or LTV is, right? Yeah. So then we work out, well, okay, cool. If a customer's worth to me $30,000, how much can I budget to spend to acquire or find a customer like that, right? And there's a few ways and then there's a ratio. If you're a high growth business, you're looking to grow really, really quickly. Yeah. Empirically, they say that you can afford to spend 1/3 of that lifetime value on paid acquisition. I would say that if my customer is worth $30,000, I can afford to spend $10,000 in marketing, advertising, whatever activity to acquire that customer. And that's what we call that $10,000 is called a customer acquisition cost. So that's what the CAC. So that's CAC. And so when you hear marketers or just like, investors or whatever mention this about CAC, that's essentially what that is. It's what is the cost to acquire a customer, CAC. And so what that CAC comprises of is essentially every component of expense that you're spending to win that customer. So that includes advertising, it could be any brand marketing you're doing, even the salesperson, if you've got a higher sales team to win that person, that a part of the chunk of their commission or wage should actually be built into that CAC number. Yeah. So that's the other component of CAC. And then AOV is the last one, which, what's another average? So that stands for average order value.
Yeah.
That is essentially what is the average revenue or order. Yeah. Average order of revenue that a customer is paying me each transaction. Yeah. So again, back to my accounting firm example, if someone's paying me $1,000 a month, AOV is $1,000. Essentially.
Yeah.
Yeah.
Yeah. Awesome. I like that. And as you said, there's lots of different formulas. I like that with CLV, or that customer lifetime value, that you're valuing that at gross and not at revenue. And I think that, we know there's just so many people that see revenue and don't see everything that comes out. When we run Facebook ads or Google ads, like, I'm so conscious of that, I guess, the margin, it's like, yes, we returned you 2 times your ad spend. That's not enough. If it's not, and like, if it's not at least 3 times your ad spend, and that's probably not even taking into account our costs yet, it's not a great campaign. And I think, people sort of don't always understand that revenue is wonderful, but you don't actually end up banking the revenue. You don't end up at the end of the day with the revenue. And I think, thinking about your customer lifetime value at the gross is so, obviously that's why you do what you do, but it's so intelligent, because you're already, factoring what they're really worth to you, not just the pretty figure that you could kind of go with and plan around and feel really great about,
But it's 100% right. It's actually a common misconception that we see with business owners, because everyone looks at it from a revenue perspective. But as you said, it's all about, like, one business has completely different margins to another. And I think where it got lost in kind of just everyday kind of jargon and the calculation interpretation of the metric was these kind of metrics were, I would say, invented or coined by a lot of like Silicon Valley tech entrepreneurs and software investors. And where if you're looking at software businesses, software or subscription SaaS or software as a service or subscription software businesses have very high gross profit margins, somewhere we see 80, 90%, right? Because they've already built the product, they're just kind of selling.
Correct. There's not the manpower involved with, exactly
right. So in that instance, their gross margins are very similar to the revenue. So they just it's just revenue as a heuristic. But then try and translate that kind of that theory into other businesses like e-commerce, where you're actually selling physical product and widgets that do cost money at a lot lower margins at maybe 40 or 50%. It makes a huge difference, right? And I think that's where it got lost somewhere in translation. And that's why I say it's really be careful when you are searching the internet for how to calculate these things.
Yeah, totally.
Well, it's confusing because there's always like 5 or 6 different ways to calculate it, and they're all it will give you very different
results. Yeah.
It's concerning, but it is what it is. And so, to your point, like the whole ROAS metric as well. That ROAS number is actually contextual to 100% of the margins of the business that you're working with. For sure.
Yeah, totally. No, that's fantastic. Oh, thank you. So I think you obviously have quite a talent for breaking down those complex, I guess, scenarios. It's not stuff that most business owners are, comfortable with. And I think I've, done work with people in your business, and I think they do an amazing job of making it really easy to understand the more complex areas of the business and to build your confidence in your planning and forecasting and understanding how your business actually is performing versus that net bank balance that you get to see every morning.
So important though. The bank balance still is an important data point. I still do it as well.
And that's part of that's part of that profit first thing as well. Because if you have all the money in there, you think that you're flying high and you start to make silly decisions. Some people, obviously not everybody, but if you have if you have a realistic balance, or if you've moved things away that are rainy day funds or are other funds, and you're looking at a small, you don't go, oh man, we should buy this, we should go on this, retreat, we should do that. So I think it's it's a fantastic marker if you're managing it properly as well.
For sure.
Well, thank you so much for your time today. It's been such a great chat, and I think it's going to be really beneficial to everybody that listens to it.
Thank you. It's been a blast. Thanks, Marianne.
Hey, thanks for listening to another episode. If you don't want to miss one, make sure you subscribe to the show in your podcast app. And if you love it, be sure to share it with friends and colleagues who you think could benefit from increasing their digital marketing confidence. Want more? Head to marianneamies.com to find out how you can work with me directly, to reach out to have me speak at your event, or to grab yourself some free resources.